Pinpoint entries with little to no drawdown. It's everybody's dream. I'm going to give you a set of market structure rules that allows you to find those higher probability entries, regardless of trading system or strategy, regardless of time frame. Just like all of my other videos, down in the description below is the link to this slideshow for you to download or follow along. And while you're down there, make sure you leave a comment so that way you can enter in to this month's giveaway. And you might as well like the video as well while you're there. So by the time you're in with this presentation, by the time you're done with this slideshow, you should be able to identify higher highs and higher lows, lower lows and lower highs, internal and external structure, how the market moves in 3 pushes, understand fractal markets, and then we're at the end. I'm going to tie it all together with practical application use for you to actually go forward and practice and find those optimal entry opportunities. Now, I tend to put a lot of words on the screen, so you have to bear with me, and hopefully my voice doesn't become too drone-like or boring so that you can't listen to what I'm saying, because all of this stuff is incredibly important to once we actually get to the pictures. I need to define a few things in order for you to understand truly what I'm talking about, and this goes for all experience levels. It doesn't matter if you're brand new or you've been around the game for a few years, this stuff matters, and I'm going to show you exactly how you can identify these things with pictures here in a second. So what is structure? Structure is going to be a series of high and lows, which we call swing points. Tops of these swing points are highs and lows, and this is what makes up the structure of the market. And whenever you have a higher high is whenever the market is going to close above a previous swing level. Lower lows is whenever we're going below previously established lows, making lower lows, all right? Pullback is after one of those levels has been created. So whenever a higher high or a lower low has taken place, maybe we're in some sort of trend, maybe we're in a breakout, we're going to pull back and the market is going to break out of a higher low, pull back and continue moving in its intended direction. All right, what is a breakout? And defining what a breakout and what a failed breakout is going to matter a very significant amount, again, once we get to some pictures. So a breakout is a price that breaks above or below an established high or low. A failed breakout is kind of sounds like the opposite of a breakout, right? Whenever we break out of a established high or low, and then the price returns back up into that previous range, and then usually travels back to the other side of that range. A trend is a series of high and lows, making either higher highs or higher lows, or lower lows and lower highs. And this was what would define a uptrend, higher highs and higher lows, or a downtrend, lower lows and lower highs. A break-in structure is a counter trend structural break. So let's say that we're in a downtrend, making lower lows and lower highs, and then the market makes a higher high. That's out of whack. It's strange. That's not supposed to really happen. It's telling us, it's a leading indicator for something that could be coming in the near future. So a directional move breaking below previously established high or low, in line with current trend structure. So again, if we were in a downtrend, we make a higher high. If we're in an uptrend, we make a lower low. That sets the market out of whack. That could inform us that we're about to go into a period of consolidation, or that the market might even be reversing. And then trading range is all price movements on the inside of a high and a low, typically unable to exit that range. So we have all areas or all market conditions shown in one picture, which is pretty cool to see. We're in a downtrend as we're coming from the left side of the screen going towards the right. We have lower lows and lower highs. We have pullbacks within that lower low, lower high structure, right? Swing point, lower low, structure, lower high, structure, okay? We're getting pullbacks and breakouts to the downside and pulling back and breaking out to the downside, eventually winding up in a bit of a trading range where we've stayed inside of a high and a low for an extended period of time, and they can't seem to go any higher or lower, eventually making a higher high. And now we've broken structure to the upside. We get a higher high and a pullback and a trend continuation or a break of structure to make higher highs and higher lows, now shifting to an uptrend. But most of you probably clicked on this video to identify how to actually identify those swing points, and then of course how to enter in, which is going to come a little bit later. So let's objectively define how to identify a high and a low, because if you don't do this, especially when you get down on those lower time frames, the chart becomes noisy, there's too many candles, and it becomes a little bit more difficult to read if you don't know what you're looking for. So step one, low is formed when a solid candle close above a pre-existing high. So what I've done here is illustrated that we were in a small lower low, lower high structure. I use that as my starting point, okay? I've just grabbed the last high and low for the demonstration purposes of this video to demonstrate that when we made this high, this bar right here is the one that closed above that high. So that created this low, okay? This is the break-in structure that created this low, all right? This bar closed, I draw this line. I don't know how far this is going to pull back until this bar right here closes above this high. But how do I know when to draw this line? All right, how do I know when to draw this line? What if it just, does this and it keeps going? Is that relevant? Well, look at this bar's high and low, okay? And do you notice how this bar closed lower? And so did this one. These two bars have closed lower than this bar's low, which tells me that I need to draw this line here because that just became a relevant swing high. That is step two, all right? So step one, we've drawn a low, we've broken, all right? Step two, we have pulled back far enough for me to identify this as a swing high. And then step three is we break above and close above that previously identified swing point, and I draw my now existing higher low. All right, I have just objectively identified my structure. Pullback, high, break, low, pullback, high, break, low. And luckily, forming a lower low, lower high structure is no different. Same exact rules apply. It's just now opposite. Okay, so I've started and I've chose a starting point high and low just for demonstration purposes within this video. And then we've started making lower lows and lower highs. And one thing that I really want to point out to you is that you notice how this is a 1 bar pullback. They have not even traded above this bar's high and closed. And if they did, there wasn't a second bar closing higher for me to identify this as a relevant low. So what I do here is I just let the market keep going. And then it does the same exact thing. We're in between a high and a low. This is a trading range. This is not a pullback. All right. So it does not count. And then we continue to go lower and it does the exact same thing again. Now we finally break down and make a lower low, and then this bar closed slightly above this bar's high, and then these two bars definitely closed above that bar's high. So now I can continue with the process. I draw my low. The market can trade sideways for as long as it would like, because right now I'm in between this bar's or this swing point high and this low. I'm in a range and possibly in a pullback for a continuation. All right, so I've drawn my low. That's step one. Step two, we break, and then I draw my high. Now, how am I identifying where that high is going to be formed? What I do is I look at where was the low formed. So that was right here. And then where did that low break? And I draw a U. All right, and the highest place that I have to draw or connect in that U is going to be where the high is drawn. All right, from the highest wick, I will draw a U and I will draw that high right there. And if you're struggling to understand how this is going to matter, this is me identifying which direction the market is currently going right now, intraday. It could be over a long period of time. And I'll show you on a 1 hour chart exactly how you can apply this to longer time frames as well. Here it is, next slide. This is a 1 hour chart. All right, all those other time frames that I just showed you were a 5-minute chart, and we're even going to go down lower than that to a 1-minute chart here soon. But here's a 1 hour chart, and each one of these lines represents a new day starting. So these are over the course of multiple days and even multiple weeks of market structure. Using those exact same rules that we just applied to a 5-minute chart, we can now look at how the market has been moving over time, making higher highs and higher lows, higher highs, making a lower low, indicating to us that the market might be going into an extended period of consolidation, or that the market might even be changing directions. We get a pullback, and then we continue to make lower low and lower high structure, and that will continue until we make a higher high and maybe the market decides to go back to an uptrend or maybe an extended period of consolidation. Before I even start the slide, do not let the fractal nature of markets or internal swings start to confuse you. Don't let it whipsaw you from here until Sunday. It's some fancy phrases or terms or words to describe a very simple concept. Everything happening on a higher time frame happens far more frequently down on a lower time frame. So let's say that a 1 hour chart is going higher and it starts to pull back. The 15-minute chart and the 5-minute chart might go into a downtrend, and then eventually that downtrend will end on those lower time frames in order to resume that 1 hour trend. So let's say that you're a trend trader or something like that. Okay, everybody has their own trading style. Let's say that the 1 hour chart is making higher highs and higher lows, and you've decided to look on the day at that pair, and the 5-minute chart is currently making lower lows and lower highs. Something that I do is wait until the 5-minute chart starts making higher highs and higher lows to guide my decision whether or not it is actually going to be set up for that day and whether or not it will actually give me a decent entry. And I can show you just right here with this, all right? 15-minute chart, all right? We've made lower lows. And then on this day over here, so for example, if I'm a trader that looks to take shorts based off of this, you know, the market's making lower lows and lower highs and it starts to pull back, Asian session opens up, maybe London, you know, I would at least like to see the 5-minute chart break down and start making lower lows and lower highs if I was going to take that trade. However, over here, the 15-minute chart breaks and makes a higher high and starts to go vertical back down to the downside, which can be kind of scary sometimes. But down over here on the 5-minute chart, you can see that it starts to pull back in that 3-legged or 3-push pullback and put in a double bottom or a peak formation low and engulfed right over here. So I could say, it would be fair to say, okay, 15-minute chart made a higher high and has pulled back in 3 legs. Maybe this was the 9:30 open, which is a time of day that I personally look to take trades. And then we get our engulfment, which is usually going to be my entry signal to be looking for an entry. And I'm going to introduce this to you right now, and I'm going to put it in a long paragraph form later on. Anytime the market breaks out, it goes sideways. Okay, if it breaks out or it breaks down, it will go sideways. And that is what I usually look for, a market to break out and go sideways. And then on the continuation, I will let it pull me in as a bit of a confirmation of the trade. All right, here's another example of lower time frames than what I just said. Last time frame was a 15 and a 5 comparison. And now this is a 5 and a 1-minute chart comparison. And you can kind of see that it looks very, very similar. Although there might be more bars on the screen, or maybe the bars look a little different. If I removed this where it says 5-minute and 1-minute, and I said this was a 15-minute chart and a 5, it would look exactly the same because the behavior is the same as the higher time frames, just again happening far more frequently down here on our lower time frames. So we have a 5-minute higher high and a 5-minute that starts to pull back. And you can even kind of see how it's come down in those 3 legs here on a 5-minute chart where they're breaking down, and then we have a pause, and then we break down, and we have a pause, and then we break down. So 1, 2, and 3, but it's just a little bit better illustrated down here on a 1-minute chart. And then we come down and we get our double bottom peak formation and a breakout and a sideways move and a breakout and a sideways move to go long, even from down over here or from up here, depending on how aggressive you want to be with this thing. However, same behavior, just lower time frames. Now, some people like these explanations and some people probably really don't. I'm somebody that personally really likes to see things on the chart, but also, you know, having these little drawings along with the chart explanations can be very beneficial. So a fractal market explained. I just showed you some stuff with real charts, all right, and how those things kind of make sense. And now I can show it to you right here with some lines. Okay, so imagine this. A 15-minute chart making higher highs and higher lows, but a 5-minute chart starts pulling back, making lower lows and lower highs. And then on the continuation of the 15-minute chart, where it starts to go and continue the trend, the 5-minute chart shifts around and starts making higher highs and higher lows. And when the 15-minute chart has now broken to new highs and is ready to pull back, the 5-minute chart will once again start making lower lows and lower highs. And on the continuation, once again, of the 15-minute chart, we'll start making higher highs and higher lows again on the 5. The same exact thing could be, or the same process could be applied to a 5 and a 1, a 1 hour and a 15, whatever you would like to do, the rules can still apply to any time frame. Whenever the market breaks to new highs or it breaks to new lows below an established level, I said that maybe it was the low of the current day or the high of the current day, or maybe it was an internal level that I've identified as a swing level. Whenever we break those levels, or maybe even a previous day's level, previous day's high, previous day's low, previous week, whenever those are broken, the market will pull back in some form or variation of 3 pushes. The market always seems to move in 3s. And when it does, those patterns tend to be somewhat identifiable, either on the time frame that you're currently on, or maybe even down on a lower time frame. So for this example, I've got a 5-minute chart up here and we're making lower lows and lower highs. We've broken to new lows below an established low. So I need to now gauge or try to the best of my ability, figure out where the pullback might end or if it's going to end. And the idea is that we will have explosive moves convincing people that it's going to go that direction. Or if I traded the breakout of this, maybe I have my stops at break even or close to, and this is going to shake me out or stop me out of my already existing short position. And it might even induce me or make me want to go long. Look how big these up close bars are. It might make me feel like I want to go long. But in reality, all this is a pullback for a market that is now broken down. And the belief is that above P2, so push 2, typically this is where people are going to be trapped. I don't want to confuse you with a bunch of extra mumbo jumbo. If you really are interested in more things about 3 push pullbacks and market traps, I've got plenty of videos on my channel about that. However, how do I know when it starts to go back down? That's going to be the engulfment, okay? So we have bars to the high, and then we have this bar right here closing below this bar's low. And why does this bar matter? Because all of these bars right here opened and closed on the inside of this bar's high and low. This bar closed higher than this bar, which makes this the relevant bar. None of these bars closed higher than this bar. They all closed and opened on the inside of this bar's high and low. Now, this bar closed lower than this bar, engulfing that bar and closing outside. And whenever the market breaks out or breaks down, it will go sideways. This bar goes sideways. And this is where I typically look to find my no heat, no stress entry. I try to put either on a 1-minute chart, so I'm looking at a 5. I'll go down to a 1-minute chart and try to get in somewhere in this bar. Or I will put a sell stop 1 tick below this bar and allow the market to pull me in. I know, more words on a screen. It stinks. Death by PowerPoint is terrible. But these are important concepts. All right, you need to understand these. You need to understand their definitions, or else the rest of this video, of course, is not going to make sense. So bear with me, please. 3 market conditions. The only 3 things the market is capable of doing is stay inside of a trading range, break out and fail and reverse, typically going back to the other side of the range, or breaking out and pulling back and trending. Those are the only 3 things you will ever see the market do. All right. Those are the only 3 things the market is capable of doing. And if you know what each condition looks like, you're already light years ahead. All right. Structural breaks. We already know what structure is. And I've already kind of explained with pictures what breaks are. We have predefined levels and whatnot. But these are concepts. Whenever a high or a low is broken, there's going to be some kind of pullback, some form or variation of a retest. A low is broken. They're going to try and go back to the high. A high is broken. They're going to try and go back to the low. Now, it might not make it there, and there might be some kind of price action continuation pattern, in which case now we can identify our market condition as breakout, pullback, and trend. And then sometimes it will fail and show us some kind of price action pattern, in which case we can look at it as a breakout and a fail and a reversal back to the other side of the range, and we can benefit from either one if you know how to identify those price action pieces. Another concept of structural breaks. The first time there's a structural break, price tends to try. This is a big one. I need to jump out of my chair and scream this in all caps, because anytime a high is broken, let's say we're in an uptrend making higher highs and higher lows, and then they make a lower low, they are going to do everything in their power. The market price is going to do everything in its power to go back to the high. It's going to see, does the market still have juice? Is it capable of going higher? It's going to retest the high in either a higher high, or it might even make a lower high, which would obviously show that there's not enough juice to get back up there. If it does make a higher high, now I just need to revert back to three things markets do. Does the breakout of the high fail? And do we start making, does it reverse and start going back down towards the other side of the range? Does it break out, pull back after making that lower low? We were making higher highs and higher lows. It made a lower low and then it broke back up to the upside. Does it break out, pull back and start making higher highs and higher lows again, which could indicate that we are, or price is going to continue to move higher, right? Structural breaks, part 3. After a new high or low is formed, the market will pull back in a way that will, like I just said in the last slide, the market will give you an appearance. It will look like, or try to stop out traders that have the direction of the trade or the direction of the breakout correct, but they have timed their entry incorrectly. It will try to scare you out with large bars, fast moving candles, scare out traders who have the direction right, but they have also timed their entry correctly or incorrectly. And it will also, in the same way that it tries to scare you, induce you to take the opposite side of the trade using large, fast-moving bars, spiking up and down, and making you believe or, use emotion to get you into the market in the wrong direction. And when the market breaks down or breaks out, this is a big one. And again, I wish I could just start jumping up and down on my desk to show you how important this is. Anytime the market breaks down or breaks out, it's going to go sideways. Anytime the market breaks down or breaks out, it's going to go sideways. It could be one bar. It could be a few bars. If it's a few bars, we might be able to consider that a lower high or a higher low pullback. Either way, this right here needs to be highlighted. Anytime the market fails to go higher, it will retest the low. Anytime the market fails to go lower, it will retest the high. I think I said that earlier on. So everything that was just on that last slide is going to be represented here with very sophisticated line drawings. We can have a high and a low. All right, internally, maybe this is a previous day's high and a previous day's low. Could be a previous week, could be a previous day, could be the current day's high and low. It could be some kind of internal high and low. And then I've drawn this as a bit of representation of the different kind of patterns that you could see. Okay, so a lot of times with like previous day's high and low, you'll notice that price breaks out and pulls back to those areas and then continues to go higher or lower. All right, I know these are all long examples. You could take these exact same patterns, flip this over, and it would just be a shorting example. You could also have a pin through the high. Sometimes market will pin through the high or even break out just for a couple of candles, reverse back down, pull back, right? Breakout, pull back, and then start to squeeze to go higher and do an expansion of the previous high. You could also have some of those earlier variations that I showed on previous slides where you have lower lows and lower highs, and then a higher high, and then a higher low for trend continuation. Or you could have lower lows and lower highs, and a higher high, and a lower low that fails, breaks out, and continues to go higher. Pretty much all of those concepts that we just looked at on the previous slide have now been represented here in this picture. And of course, I wouldn't leave you hanging without actual real-world examples. All right, I've got some previous days highs and lows up there, just helping me to identify which way the market overall is currently going. However, if you look at the internal structure and things like that, you can see that even though we're, overall we're going lower, look at what's happening. We've got a very long strand of price movement with no significant pullbacks and a breakout to the downside, and then there is no established low here until we get this pullback. So now this is the low. Now this is also the previous day's low, okay? I don't want to confuse or anything like that. Let's just look at the structure of how things have happened and think about the rules we discovered or talked about earlier in the slideshow. So we've broken out. The market is in breakout down. We have no significant pullback, which means that the current structure of the market is, and then we pop back up once and twice and 3 times. And then on the day, this is a 15-minute chart. On a 5-minute chart, this actually made a lower low on the day itself, because at the beginning of the day on a 5-minute chart, this would have looked like we were making higher highs and higher lows, and then it broke down and made a lower low. Now we know that based off the rules and how markets are fractal, we're in breakout down. This is a breakout market going down. And this could just be identified as a pullback, but it's nice to see a lower time frame start to shift and then at a certain time of day for that continuation pattern to take place. Trend the market. This is a much more recent example where the market had pinned through the previous day's low or made a lower low, okay, and then popped back up again in that 3 push pullback variation. So we have a lower low using the structural rules, and then we've popped it back up in 3 pushes. Once, twice, 3 times, and then everything in here was on the inside of this bar's high and low, which has broken down below this bar's low. And then we've gone sideways for an extended period of time. This bar here breaks out, breaks down. The market then goes sideways. Now, this bar didn't close on the inside, but it's still a bit of an indecision. Okay, it hasn't made a wide or a large range bar. It has made a more of a narrow range bar. It's not a doji necessarily, but it is a bit of a pin, right? A pin bar or a pin hammer. That is considered a sideways bar. These are sideways bars. These are sideways bars. This is also an inside bar in between this bar's high and low. So if we were to insert any of these variants over here, we can consider those sideways bars. So we break down, we go sideways, and then I can apply I'm going to try and get in the sideways bar, maybe on a lower time frame. Goodness gracious, or 1 tick below that bar. Yet again, another variant of we're making lower lows and lower highs, all right? And also, it looks like maybe we were broken down or broken out. And in the market, so we make the lower low. Again, think about the rules, all right? It's not about this bar and that bar or whatever. It's about the rules for what I'm doing. We're making lower lows and lower highs. They've pulled back in 2 bars. I draw that low across, and it pulls back in what appears to be 3 legs or 3 pushes, all right? It's pulled back. And then we have a 1 bar range, a 1 bar high, and then this bar breaks out below the low of this bar, and then the market goes sideways and then continues to go lower. So what could be the practical application of this? Well, it depends on what your trading style is. If you're somebody that trades intraday, then maybe you can use this intraday. If you trade over maybe larger periods of swings, or you're a swing trader or something like that, you can apply the same information to that. Now, I trade more of an SBT, BTMM style. So I trade intraday, but looking at the previous day's highs and lows and setups that are built over the course of 3 days in order to find larger moves. But I still use the intraday structure in order to help me determine whether or not the setup in my thesis is correct. All right, so my line of thinking: did the market make a lower low? Did the market pull back? How did it pull back? Lower low or a lower high? If it was a higher high, did the breakout, or maybe did the market make a higher high? Depending on the direction, right? If I'm trying to go long, did the market pull back? How did it pull back? Did it make a higher low in line with higher high, higher low structure, or did it make a lower low? And if it did make that lower low, did the breakout of that lower low fail? All right. After I answer these questions, or this question, I wait for the market to break down or break out. Then it goes sideways. This is like the process, right? The process I go through to find my entry. And then I try to get in on the follow through, because usually that is where we've broken out. We've tried to retest the high. It failed to do so. Okay, let's expand the range to the downside. And that is where I try to get in, because that is going to provide usually a higher probability of no drawdown, no stress entries. This is another one of those slides that I just want to get up on my desk and start doing a little dance. All right, it'll save you. It's not clickbait. The slide is not clickbait. It will save you an enormous amount of time if you understand these things. Higher high can lead to a lower low. That lower low can then lead to a lower high, in which case we can look for. And then maybe we could have a higher high go to a lower low. Think about this. These are structural breaks. We make a higher high, then a lower low, break in structure. Then we get a lower high, and then we get a lower low. So now we're transitioning to a lower low, lower high structure. Or maybe we were in a higher high, higher low, and then we get a lower low, break in structure. Then we get a higher high that fails to go higher, and then we get a lower low. We have some trap variations, in which case, what it says up here on the screen, all right? I'm not going to read through all this. But you get what I'm trying to say. If you just understand that this is the process the market goes through whenever it's forming these highs and these lows, and now you have some very objective ways of looking at those highs and lows, you're already way ahead and light years ahead of looking at the chart with more objectivity and building a solid process for yourself, and also being capable of building a thesis on the day going into your session. So for example, let's say that I wanted to go short today. Maybe I had a pre-existing signal or setup from the previous day. It closed a certain way, and I said tomorrow looks like a sell high opportunity, and I need to be able to perform in that environment. And then prior to my session beginning, I noticed that we've put in a low, we've put in a high, and we've been trading on the inside, and then boom, they make a lower low. Well, now I can zero in on this pair a little bit more and say, okay, it's starting to do the things that I need it to do. And then it has popped back up in a bit of a 1, 2, 3, and even gave us a larger run for 4, because notice this 1, 2, 3 never closes below this bar. So I don't know that this is a 1, 2, 3. I just say, hey, that's 3 bars. And then I'm waiting for something to close below this bar's low. But then this bar goes higher. So now I'm waiting for something to close below this bar's low. And then we get that. So now we're in lower low, possibly lower high. We haven't made a lower low yet. And we start to break down and go sideways. Now I'm going to take a little heat on this, and that's okay because I'm going to put my stop in a place where it's an invalidation point, okay? We go to 1, 2, and 3 sort of structure here, a 1 push, 2 push, and 3 push. So I'm usually going to put my stop somewhere up in here as my invalidation, because I think that traders should be trapped in that area now at this point, and we should be going lower. Now, let's say that I didn't get in here. Let's think about timing. Let's think about maybe this was in the gap time in between the London session and the New York session, just that in between. All right, New York session for me opens at 8 a.m. Eastern time, and then it makes a lower low. So now it's like, okay, well, we're still making lower lows and lower highs, and we've popped it back up. I have to wait for a pullback. Let's see how it pulls back. All right, we get a big run, and then a pause, and a big run, and then a pause, and then a big run, and then a pause. All right, notice all of this is on the inside of this bar's high and low, and then this bar closes lower. So this is a breakout, and then this breaks down. Excuse me, it breaks down, not a breakout. All right, but it breaks down, and then we get our little sideways bar, and that gives me a second opportunity to enter. And then notice the behavior just keeps on repeating. Every time it breaks down to new lows, we get a pullback of some kind, or an attempt, some kind of retest of the high. It fails and continues to go lower. But sometimes it's not always that simple, and you just have to know how to adapt and use good discretion, and just think a little bit, because, you know, and I get it, you don't know what you don't know, and that's fine. So if we're looking at a lower low and lower high structure, and we put in this lower low, how do I know that they put in this lower low? Well, they broke below previous lows. We have this bar's high and low, and then we've gone back up for at least 2 bars. And I've drawn this across, and they can consolidate in between this high and this low, you know, until it continues to go lower, or it breaks out, pulls back, and continues to go higher. We might have a different kind of structure forming. But instead, it breaks out of the high and then fails to go higher. I don't know it's going to fail to go higher. We got this bar and this bar. Looks like this made a high, this made a low. We did go a little bit lower over here, okay? And then it retested the high, and then it starts to break down. All right, so I have no new highs and lows just yet. I just have a breakout of my previously existing lower high, and then now the market starts to fall back down below that level and break down. So now we've broken, all right, and then we're pulling back. 1 push, 2 push, 3 push, breaks down, goes sideways. Either over here or over here is a fairly safe entry in my opinion, and that's usually where I'm trying to get in. Once I believe that the breakout of this high has failed and is showing signs of follow through or continuation down. And a lot of times I like to look left and see, are these guys making money now? Like, for example, if I was short over here, where do I stop being trapped? There's probably somebody short on this bar, even though that they've pulled back like this, okay? So this bar here starts to let this person out. That makes me feel a little bit better about going short from this area. And then once we get down here, now we're letting out everybody, and all of the shorts are making money again, and I feel a lot safer about entering. It's probably one of my longer and more detailed videos. I hope you've enjoyed. I hope it was beneficial to you. Let me know down in the comments below what you think. Don't forget to download that slideshow, hit like on the video, and I will see you in the next one. Bye-bye.